Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today, the guys and I are going to talk about these topics. Right at the top, we have a San Diego data dive shows a market upended by tight supply. No argument there, but we're going to get into some of the specifics. Then we have, that's coming from Housing Wire. Then we have from a new player on the stage, Zero Hedge. Zero Hedge has, these are the median down payments for a house in each state. That was fascinating. Stuff. And then from CNBC back to back, we got aspiring homeowners say they face two major obstacles to buying. Here's why 20% say it'll never happen. Uh-oh. And if your parents are homeowners, you're more likely to be a homeowner, housing experts say, and here's why. So right from the top, guys, let's talk about our own backyard, our own local area. This is coming from Housing Wire, where not only does California make news kind of regularly, but in this article, specifically San Diego. So article title, A San Diego Data Dive Shows a Market Upended by Tight Supply. California is home to 39 million people, and only 55.3% of the occupied homes are owner-occupied.
We've been talking about that, you know?
At least they're being honest. Landing a California home is hard and expensive.
Yeah. You know, here's the thing, guys. I mean, it's like, here we go. Like, it's like a catch-22, right? Like, it's great that our property values are good, but at the same time, it's just...
So let's I want to go. Let's set a little bit of this stage. Okay, so in the very top of the article, yes, I'm mentioning 55.3% of occupied homes in California were owner occupied, the third lowest percentage. That's behind New York at 53.9% and Washington D.C. So while they are not, while D.C. is not a state, it's still being counted as one, at least for this metric.
It's pretty close.
At 42.3%, that's an extremely low amount. But also the primary industry or business in D.C. is politics. So politics and also all the associated things that are connected to politics. So I'm not sure that I'm surprised by that one. I'd almost
who wants
consider
to own
that
a home
as
there.
Well, I mean, I guess part of why I'm mentioning this is it brings up the concept of permanency. And I think that these statistics reveal that on one level you could say, oh, well, it's always an affordability issue. But on the other, I think when it comes to D.C., and I don't know this, if you're in D.C. watching this, tell me, you have to have a commitment to permanency there. I can see why people would commit to being a permanent resident of New York because they're there for, their family. And New York, by the way, is not just it's a huge place. There's farms in New York. Did you know that? Yeah. There's farms in New York. There's farms in California. And so you have the coast and all these other things that the reasons that draw people to New York and California, even Florida, Texas, big places like that too. But I think the permanency is the thing for me. Is people are committing that they want to be here, and in DC it doesn't sound like that's the case. Very few people.
Yeah, no, it's crazy.
But talk to me about San Diego. Let's do.
I mean, here we are. One of the things, not just San Diego, but in California, I didn't know 39 million. I was like, that's quite a bit. Mm-hmm. We're considered one of the largest states now in population.
It is
crazy.
It is the most populous state by volume. Yes,
that's pretty crazy. But talking about San Diego, guys, it is a crazy market right now that we're currently experiencing. Multiple counter offers are back. People offering higher than what the listed price is. Mm-hmm. So I had a great example that I'm pretty sure I already shared. But one of my clients was looking to purchase a home in the San Miguel Ranch area, and it was listed for $899,000. We contacted the listing agent. Hey, would it be a contender if we put an offer in at $930 with no appraisal contingency, since we're putting 30% down, excellent credit score for the buyer. First thing the listing agent said, oh no, you're really far off. I'm like, really far off, like maybe $30,000 more. She goes, no, you got to go higher. You're already in the million. We're like, what? There's no way. Sales comparables in the area of what I saw were like 950, 970 more or less, for a really fixed up property. This one needed some repairs. Wow. Well, fast forward a month now, that property closed for $1,050,000.
What?
Yes. For $1,050,000 FHA financing. They went in there with that.
Wait. Don't let that pass people by. Say it again. $1,050,000. And what kind of financing?
$1,050,000 with FHA financing. And when we talked to the listing agent, she said there was a no appraisal contingency either. For some of us that are first-time home buyers, in order to compete in San Diego, we're putting a no appraisal contingency, which means if the value is less than what I offered, I'm committed to that price either way.
So if you were to guess, why did they do FHA? What would you
less money
guess?
down and the lower interest rate.
So some of the reasons, and this is for the audience, so the part of it is lower interest rate, number one, which also then makes the DTI better, the debt-to-income ratio,
Correct.
or maybe they need the higher threshold with FHA that's not afforded in conventional. Also, maybe their credit score is possible too, and lower down payment. So I want to squash the idea that FHA is for first-time home buyers only.
Yeah.
It is not. It is not. This is a $1 million home that someone's waiving the appraisal contingency for, which means they have enough money to cross the Rubicon, if you will, if it comes short on the value. Yeah. But also maybe they needed it because of the lower pricing or on the interest rate, higher DTI, or their credit.
Who knows?
Yeah.
All I know is they closed, which is crazy.
Insane.
Yes.
So to add on to Will's point, so since 2019, 2020, I feel the San Diego market has been riding a high, and we've only seen slowdown in certain pockets of the area. But the article goes on to say how broadly San Diego followed the same pandemic era trajectory as the rest of California. But what stood out to me is that as sales boom between 2020, 2021 / listings, and we're still seeing that same effect. Now, also this brought up a huge role for at home living as well. I mean, at home working as well.
Yeah.
So that also played a big role in people having to stay home, because now you're staying at home. You need bigger spaces, so therefore you're going to want to have a house that's bigger. So you're not just buying for what you need, but for what you want, but now also what you need. So hey, home office, bigger space. Yeah, we're gonna have the whole family at home. So that also played a part in everybody saying, hey, well, I'd rather pay more because I look at myself staying here for longer than not. So I'm willing to fork out that extra $1,000, $2,000, whatever, because of the fact that if you buy in San Diego, if you're able to and you can afford it, the long-term play is very, very positive and lucrative.
And I see it on both ends of that, because you see people that kind of pot committed to buy a house for maybe more than they would be comfortable with, but they could afford it when rates were low. So they're like, oh, I can walk myself into this house that's maybe priced higher than I would have looked at or considered a couple months ago. And at the same time, because the rate's low and I can afford it, I'm probably going to stay here longer. And last week we're talking about that other report, and that data was showing that people have increased the duration of their stay. The median stay ownership is now 11.9 years.
Yeah, that's crazy.
So and that's nationwide, and that's nationwide. So I think you have some of those forces at work. And what was crazy to me is again, in with that is that the number of listings in San Diego fell more than double than the national average than the rest of the country, which is insane. So we talked about propped up prices. We talked about home values not going. You're talking about people getting outbid even on an FHA deal. By the way, let's dispel the other myth. Just because you're qualifying with FHA doesn't mean that someone with conventional is going to get accepted over you or they get their offer.
Well, obviously.
Right? Obviously. But I think
because we're going 30% down conventional financing. Excellent credit scores.
Yes.
Versus FHA, not to downplay anything, but we would never think we'd lose out to that. But they
that's
offered,
the misconception.
Exactly.
Like that's the stereotypes. Oh, if they need FHA, they're not as strong a borrower. Not the case.
Just like I was actually putting it right now. Exactly.
And that goes to show that their loan program doesn't really matter if the terms and what the seller's looking for makes sense for them.
That's correct.
Who cares what you're closing? As long as you can close, that's all that really matters right now, because we've also seen that people open, but they can't close. And now the house goes back on the market.
And it's true. Just like you mentioned, Andy, when I saw the price at $1,050,000 and I see the money down, obviously it's not going to tell me the type of, but you can do the math, reverse math, and I figured out, I'm like, we lost to FHA. What the heck is going on?
Wow.
But I see it's $1,050,000. They took that chance of waiving that appraisal contingency
Roll the
because
dice.
they're like, what do we have to lose?
Wow.
We already want this property, and so they managed to get in there, with minimal money down.
So one of the good things that we keep saying they waived the appraisal. The good thing is that you still have your loan contingency in place.
Correct.
So regardless, you can still wiggle your way out, or you still have an out, and you don't have to basically put your EMD at risk. So that's also a very strategic move that a lot of people are taking so that they're able to get their offers accepted.
Yeah, getting to San Diego is just becoming how do we get creative?
There it is. You said it. How do you get
creative?
creative?
And then relationships matter.
100%.
So.
Wow.
I think that's actually a huge part that, every real estate agent is going to go ahead and say, or every industry member is going to say, oh, it's about who you work with matters. And, over the years, you start to find out that it really does, especially in competitive markets like San Diego. When you go across someone that you've done work with, that they know how you work, that they know how your team works, how you guys perform, when they see your name and they'll see it over and over again, they're going to be like, hey, I don't even have to think twice. I will take their offer because I know that they can perform. Where it's like, hey, yeah, this other offer is good, but I don't know them. I don't know if they're going to close. My seller's in a hurry. I'm going to go with who I trust and what I can, who can get the job done.
I think this also makes the case for being a backup offer. Like if you're looking to buy a house right now, or maybe you're in the process of looking for homes, you haven't found the right one, or maybe you've been making offers. Like, yes, okay, it's fine. Someone in this case got that deal, but again, let's say that deal. Let's pretend that deal had fallen off. What'd they do? They'd go to number 2. They'd go to number 3. They'd find who else is still in line who wants this house. And so, I guess the point is like, don't give up. Like stick to it. If you're already qualified and you're looking to buy a house in 2024, like just stay the course, because if that deal had fallen out, and Will's saying right now, well, if maybe we could have been in second position. I know we weren't necessarily in this case, but let's just say that could have happened.
Well,
then someone would have been, because we're not the only ones. And
I mean, you guys see the data. Where listings were half than what the nation has.
Yeah.
So we're like so limited of supply. That's why it's a very lucrative place to purchase right now, a home in.
And here's the other thing that I knew. I know that we know this because VA is our specialization, and we have done predominantly VA for the majority of our business's lifespan now. And it mentions it here. San Diego retains its distinctive preference for VA loans as compared to the rest of California and the rest of the United States.
That's right.
VA was the second most popular purchase mortgage loan throughout the period in San Diego. This is the period from 2019 to 23, while FHA was the second most popular. So
in the other parts of the nation, right?
Yes. Yes. So
which
VA
is pretty
for
crazy.
here,
here.
You've talked about this before. We're landlocked on the south with Mexico. We're landlocked to the west because of the water, and we're landlocked to the north because of Camp Pendleton. And then we're landlocked to the east to a certain degree because of the mountains and preserve and that kind of thing. So you're talking about like a corner of a dot in the map on the United States where it is highly contentious. There's a lot of competition, and VA is still in the game all the time.
It's very warning to see this, because I know when I got in the industry, VA was just kind of like, you got a VA loan? No, you're not.
No,
we're not going to even go with
your... It's like an FHA.
Oh, it's strict. It's this, that, So people would deter veterans from buying homes. I'm glad that the rules and everything has changed as we went forward, because we have some of the biggest bases there is, military bases. So how do we serve that community? I'm just glad to see this information, because it helps us understand that we are helping that community now achieve that dream of home ownership.
Do you remember in 2005 and 6 and 7 asking about VA, and was like, we don't even do VA.
What is that? No.
You're like these are like the biggest banks lending money in like the craziest time, and they're like, oh, we don't do VA.
But Andy,
like,
remember it was like $350,000 the medium sales price, and that's the max it could purchase at 100% financing.
Right.
So the medium sales price at that point in time was like $620,000.
Yeah.
So I was like, what veteran has the difference to come up with that money down?
It didn't make sense, because there was other market options which turned out to be pretty sour, like 100% no fine, 80-20
piggyback.
That stuff, no credit, fog a mirror and get a loan. So I understand it was not popular, but again, it was the VA had to change some things along the way too, and then banks had to kind of warm up to go, wait a minute, this goes back to our whole argument about creativity in tight markets. Is the banks in the industry will figure it out, because they need to make money. They want to make money. They need to make loans in order to make interest, to make money for the people that are dumping money and parking it with them, hoping for a return.
And I'm glad that you're mentioning that, because Fannie and Freddie, they've been doing a tremendous job to try to get people enticed, new first-time home buyers, et cetera. We had more, and this article doesn't say that, but there was an article that more new home buyers came in 2023 versus 2022, when the rates were in the 4s.
Right.
Versus now the 6 is 2% higher, but yet we had more first-time home buyers coming into the market in 2023.
Yeah.
And that's just because, again, Fannie and Freddie came up with 5% down that you can buy now a multi-unit property. When before that wasn't the case.
Yeah.
So I'm glad that they're there and they're helping the community, help them achieve that dream of home ownership as well.
Yep. I think part of this is a reflection of just our mix of who's here in San Diego because of the military, and even a really pretty I'll say healthy veteran population that's not active anymore. There's still a lot of that going on, and conforming is different in San Diego, it looks like. I mean, the data suggests that, and I am not really surprised that VA is overwhelmingly used a lot here.
Yeah. I also liked that article talked about the real estate companies, of how much listings are actually getting. It was pretty cool to see that information. And you just get to see like the companies that pivot with the changing times are just going to be that much more successful than the ones that are just kind of,
That's what I was going to say. Companies that were poised with the right infrastructure were able to, take on the new business, or take on the business that others weren't able to innovate into or be able to take it as the times were changing. So I thought that was pretty interesting.
I know, I like that. EXP came in like one of the top ones, and then Pacific Sotheby's, when they were before in first place, they actually just fell to like 10th place.
Right.
Like, it's just crazy.
I think a lot of it has to do with like how the structure of their business, how many people they keep, what kind of recruiting you have, what the stickiness of those people to their career in real estate is. Obviously, their client database is going to prove or not prove worthy in the end of creating deals or not. So there's a lot of those things on the table too. But I mean, EXP I think came in number 3 on that list of the amount of scale of growth during that time.
They went from 11th in 2019 to 3rd in 2023.
And EXP, for those of you who don't know, is virtual. Right?
Yeah.
I shouldn't say virtual, but like
absolutely.
They're not as brick and mortar as like your Coldwell Bankers and Keller Williams and all that. So we're kind of more primed for that moment, and then you can see as a result they jumped that list all the way to number 3.
Correct. Like the best way to compare that. The best way to compare it is like your Blockbuster and Netflix, right? Yeah. When they went in there. People, I got to go and see the video. When Netflix was like, wait a minute, you don't. You could have it from your phone, etc. So this is the way they're doing. Everybody is more brick and mortar, and now EXP is going to a different way where it's going to be more virtual.
Yeah. So like you were saying on that, I think before people were more keen on going towards the big companies, the big names, the ones that were there, the good big corporate companies. But now these virtual companies allow for people to connect with people that they trust, that they relate to, and that ultimately have similarities. And I feel that's the way where a lot of sales businesses like that are relatively like ours, where it's not about the company, but it's about who you are within the company and the brand that you give out to people, because your company's your company, but they're doing business with you. So if you're able to overcome everything else, who matters what company you're with? They like
it used to be like the 3 L's for real estate is location. Now it's relationship, right?
And also, and I think also maybe overlooked or maybe even unseen is the fact that during that same time there are a lot of people that left their traditional brokerage for EXP. So I think that has a lot to do with style and future pacing of where are we going as an industry, how much more are buyers looking online, and I mean just that whole virtual experience, if you will. It's migrating a lot of people towards that. So I think that helped push.
Brian brought up the people are buying more of the homes because they're using home office.
Right.
And so instead of going to an office and paying a desk fee like the traditional way of doing things,
I'll eat my desk fee.
Yeah, why pay that desk fee when I could just pay at home?
That's a really good point. You eat the desk fee, and I'll pay more on my house. But hey, your house is gonna pay you out in the end. Your office ain't.
I have a tax deducted.
And exactly.
Yeah. So, wait a minute, we're at our office.
Yeah.
Wait a minute.
All right,
that's
guys.
for different purposes. That's different.
I enjoy seeing you guys. So
all right, well,
that ain't gonna happen here.
We're social creatures. That's different. So I need to speak to people. I don't just need to be in front of a screen.
Nothing virtual yet.
Next topic. How do we turn this office to a money maker for everybody? Okay.
Can we make this a primary? Yeah.
All right, guys, these are the median down payments for a house in each U.S. state. I was not surprised by some of this and really surprised by others. This is coming in from Zero Hedge. There's an awesome map, which we're going to throw up on the screen, as well as a list of every state, and again, D.C. being considered as a state, talking about how much is the median value per state on a down payment.
I mean, guys, I have this big old grin on me because I'm like, what the heck? I've never seen these numbers like that.
So what were you surprised by, first of all?
I just like seeing the information of like the down payments for every state. You know what I mean? It was pretty cool to see that.
Did anything like jump out at you though? Like did anything surprise you? Like, oh, wait a minute, that's not.
Of course. Okay. Now I'm going to go invest in some of these places that I didn't think of,
Less than $10,000 median down payment?
Exactly.
For me, the thing that came up is people are constantly saying, oh, you don't need 20% to buy a house. You don't need, you just need the minimum. But data shows that otherwise that isn't true. And a lot of these countries, including the top 17, including these states, all top 17 states are none under 15% that you come out of pocket. So, So in these top 17 states, the average is 15%, or that'd be on the low end. I don't know about the average, but nothing lower than 15% is getting put down to buy a property in those states. Wow. So to me, that's like, yo, whoa, what's driving this up? We just talked
Well,
about
the
it.
cost of homes, right. There's that, but I don't know if you guys caught that note on the bottom left. California has the top 3 priciest urban housing markets for down payments overall: San Jose, Sunnyvale, San Francisco, Oakland, and Los Angeles, Long Beach. So those 3 kind of make the top. And here's the thing: even though those are the top when it comes to the priciest urban housing markets, California is a state still number 5.
Yeah, we got other toppers.
which is crazy because you have Washington D.C., Hawaii,
New York.
I see. I'm not surprised by those ones, right? Here's what I was surprised by. I was surprised that Texas was so low, because you look at Texas. I marked it here on my page. Texas was number 38 on this list.
Yeah, I'm not surprised at that.
Well,
I'm really
can I
not
tell you why real
because-
quick?
Okay, yes.
So here's the reason why. Austin has had tremendous growth. People moved to Dallas, Houston, San Antonio. Like, there's been a ton of moving to Texas.
Correct.
You've seen property values go up extremely quickly during the same window of time this is being measured. Yeah. I thought for sure because of that, and that money also coming from places like New York, like California, it would have increased their median down payment a lot more than I thought. That part did surprise me.
I know there's a lot of truth to that, but then at the same time, they've been seeing that growth in the last few years. Mm-hmm. It hasn't been like 10 years. It's been the last 2-3 years, where Californians are going over there.
So maybe they would have been 40 something.
Probably, but yeah, maybe. But for me, I wasn't surprised because it's also a big state. There's so much more to build. And so it didn't surprise me on that one.
Yeah.
I mean, they're also going to be leaving the United States.
Yeah.
Okay, come on. Jeez. Look, now in its own country, Texas. Yeah. That's a different show, I think.
But, thinking of where I'm going to go invest now, I was like, okay, I'm going to go to, Mississippi, where the medium out of pocket down payment was $5,800.
Right.
What are you getting, though?
Jeez, well, I don't know, but long-term longevity, right?
$1,500.
The neighboring city right there or state is Louisiana. I'm like, okay, that's $6,500.
Yeah, that was our electric bill last month, right?
Yeah. Our home insurance.
We're gonna get so much crap in the comments, like these a-holes.
You guys live in California.
These a-holes.
So no, and to finish it off, the average was only for the United States as a whole, 15% was the average.
Yeah.
Yeah. Well, and I know that's what's so interesting to me about this is that there's so much. The United States is so big, broken into all these different states, and so in one hand you're like, okay, cool, the average is this, but then if you look at like how much is above that and how much is below that, man, the difference between top and bottom is so skewed.
Crazy.
It is massive. The what was the bottom state, guys? Was it
Mississippi at
Mississippi and
Louisiana? Yeah, Mississippi, $5,800, 9.3%. And here's the thing. Are you guys catching that? That the median down payment of $5,800 is a down payment of 9%. Make it 10%. That's the down payment.
Yeah, that's crazy.
A 10% down payment is $5,800, guys.
I'm gonna go buy one.
That means that median means that there is places that were cheaper than that and had less cost for down payment. That is insane.
So I actually jumped the gun earlier and started talking about working from home, but right here it goes on to say houses prices rose nearly 24%. And what I was going to add to that is that, between 2019 and 2021, I feel everybody got short-circuited in the way that they lived, the way that they did life. So for me, this was a big, like, okay, I agree with it because of the fact that everybody was working from home. Nobody wanted to be anywhere near anybody. So at the fact that, they didn't. It was true. So what do? They said, I'm going to buy a big house somewhere out remote and not speak to anybody. And Google could still pay me from wherever I'm at.
And that's where all these Airbnb and everything came to.
Mm-hmm. Yeah. And one thing to add to that as well is that there was such a gold rush feel where everybody was jumping in. Everybody was investing. It felt like everybody was coming to California like for the gold rush like back in the days. But it was real estate for this matter. And little did they know that there's up cycles, there's down cycles, and it's not just let me get in one time, make a lot of money and get out. A lot of these people are now underwater. They're not professional investors. They're not licensed investors. They don't do this day in, day out. They're regular people that, got misguided by social media or, got told that it was easier. But once they really got to the nitty gritty, it's like, I don't do this for a living. I don't know what I'm doing now. I have like 3 different hats on and I still got to go.
And again, because of all of this, because it's priced people out too, now we also have that other issue that came, which is the rent, right? Rent's climbing.
Well, and you had brought up too, again with the rents and even like communities and HOAs pulling the rug out underneath from people who had bought a place with the intention of Airbnb or VRBO, and now saying, oh, you can't do that here no more short-term rentals. So you got some people getting the rug pulled out from underneath them. You mentioned that quite a while ago. We haven't talked about that in the show recently, but you're right. The rent skyrocketing is part of that, and then the other thing. This is the part that surprised me. First of all, Texas being so low on the list surprised me. Second thing that surprised me in this was that the national average for down payments has more than doubled in quarter 1 2020 to quarter 3 2023. So it went from $13,250 to $31,500.
Wow. That's an extra $18,250 in 3 years.
Yeah,
you don't even get that increase on your job.
That is insane.
Yeah. You don't even get that.
Well,
hey, by the way, I think car prices did the same thing. Car prices, hey, wasn't that Toyota Corolla $13,000? No, it's 31
everything
now.
has done the same thing. Everything has done the same thing. I know my mother-in-law does this popcorn that she does in Christmas, and the bags used to be like A tall, and then all of a sudden it went like A tall and the same price.
That's what I was gonna.
Sizeflation.
I saw a video.
Everything.
I saw a video. Somebody's like, yeah, what's going on here, guys? Like, am I not getting the picture? Like, I see the exact same sizes, but these prices keep going up. Where are the portions?
Yeah.
Why are the portions going up?
Yeah.
That ain't gonna happen.
On the side, I used to say 50 servings. Now it's like 37 servings.
Yeah.
Whoa.
So with all that stuff, now we're also starting to see more young people staying at home longer because of that.
Yeah.
They just can't afford it. But the luxury, that was what's interesting too, is luxury homes, like you mentioned, they're buying those bigger homes because now, hey, well, instead of my son paying his mortgage or paying rent, now he could just live here and
get a bigger house.
So the other cool, like, and this
Pretty
is
cool.
a super nerdy thing. It's not a cool thing. I'm sorry. I tried to say cool about a nerd thing, guys. Here's the nerd thing. The Washington, which came in at number 4, their median down payment was $86,750, which is nearly 30% down. Which says one thing about the house value, which also says another thing about how much money people got rolling around their pockets. The article kind of cites that some of the reasons for the reflection of this is jobs, income, population, amenities, and the desirability of location. And right here at the top, you have California and Washington, which are both tech-centric, tech-heavy. And so it's kind of not surprising that they're I guess I was surprised that much of a percentage represented that kind of high of a down payment. Or no, other way around. I'm sorry. That dollar amount represented such a large percentage of the down payment. I think that is very interesting. I think we're going to have to keep our finger on the pulse of that. And here's why. AI. The reason is AI is going to create some jobs and completely obliterate others.
Yeah.
So I'm very curious to see how much of these tech areas over the evolution of the next year, 2 years, 3 years, we get like 12, 24, 36 months. I think that this is going to be very nerdily, again, nerd hat. This is going to be super interesting for me to see how much has changed because of the evolution of those tech sectors in those two places, Silicon Valley and in Seattle.
A lot's changing.
So, completely off subject, but I heard fast food restaurants are moving to a model where they're going to do changing menu prices. So if there's a rush at certain time, prices are going to go higher.
Wait, what?
Yeah. I'll send you guys.
We should do that for down payments. No, I'm just kidding.
When the market's hot, down payments go, rates go high. No, but I thought it was interesting because they said the model that's going to work is like whenever they have a rush, prices are going to go up. But whenever they slow down, prices are going to adjust. And it's all AI based. And I think it was Wendy's that invested $25 million or $25 billion into this to be able to roll out these new technologies. And you're going to start seeing menus kind of fluctuate throughout time. The prices on the menus fluctuate throughout time.
Really, I always say, if you're buying your first home, you got to adjust to the payment, stick to the dollar.
Now you got to adjust at the time that you buy it.
The other version is going to be you make an order on it, and it's like a what's the machine you pull with the handle at the casino?
Yeah.
What do you call it?
A slot machine.
A slot machine. Yeah, you put your money in and you pull it, and then it determines what you get.
Wow. That's
They're
just
gonna be like,
crazy.
oh, you wanted a Big Mac. Sorry, you're getting a cheeseburger.
We got ketchup.
Yeah. That's interesting. Or you're just gonna feed the machine and you get nothing.
But I mean, to go on to that point, I feel that you're gonna have to either learn how to manage it or learn how to actually use it because it's not gonna get you out of your job, but it is gonna innovate a lot of the way that people.
Oh
do
yeah,
jobs.
no. A lot of things are going to change for sure. Definitely.
Wow, interesting. Okay, guys, let's go ahead and continue. So we are here at CNBC. Aspiring homeowners say they face two major obstacles buying. Here's why. 20% say it will never happen. Quote on the word never. More than half of aspiring homeowners surveyed say cost of living and insufficient income make it difficult to afford a down payment and closing costs for a home, according to a new report by Bankrate. The report also found a degree of pessimism from aspiring homebuyers who think they will never be able to buy a home or that will take at least 5 to 10 years And what are prices going to do over those next 5 to 10 years, guys?
Per the data.
So on the tail end of our previous conversation about medium home price down payment. I'm sorry, medium home. What am I trying to say? Down payments? On the tail of our previous conversation about median down payments, in the next 5 to 10 years, if that goes up, it's going to be even harder to chase because you're just constantly you're fighting inflation and costs over here on living and saving and trying to get a down payment.
This reminds me of 2000. New home builders were supposed to build at least 25 homes. 2,500 homes?
No, 250,000 homes to meet California's demand.
250,000
It was $250,000.
Okay. And how many do we need now?
Oh, we need 2 to 2.5 million in California to catch up on the lack of supply.
Me of that kind
That's back in Y2K.
This is like constantly chasing it. Is what you're saying.
Exactly.
It's like I'm going to go on a jog with Usain Bolt, and he's not out the gate fast than me. And then at the mile mark, I'm chasing Chichogi. What's Kokoji? What's the guy's name?
Yeah, it's just you trying to chase him down. It's not going to happen. Yeah. Put it that way.
Khashoggi? What's the guy's name?
Well, I mean, this is stuff we already knew, guys. We already know that people were getting priced out. It's right?
Okay, I get that you're not surprised by it.
Yeah.
Look, I understand why people are pessimistic. We totally get it. And you're like, it's easy for you guys to sell. You sell loans. Like, you talk to rich people all day long. Like, look, people work their ass off to try to save. We totally get it. Look, it's why we can do the show. It's because the primary business exists. The show does not pay for our primary business. This is our hobby.
Yeah.
And so, we have 51% pointing to the high cost of living, and 54% of those saying they have insufficient income given where home prices are right now. And unless something changes or new creative products come out, like we're having these conversations with people. And I would say that there's probably a commensurate amount of people that we qualify or talk to. It's about right there. Some people qualify, some don't.
So, I mean, a lot of people aren't, wrong to feel this way because I feel that they're in a sinking boat where they're trying to get water out, but there's a hole in your boat. So regardless, you're trying to take water out, but more's coming in. And that's similar to what's happening to, their financial life. Like, I'm bringing in money, but now I have to put more money out to pay for stuff. So the little savings or any savings that I was putting towards, my house, now I have to put towards just my cost of my living. And unfortunately, it comes down to two things: your habits after you have your revolving payments, and then what happens after you have your rest of your money. Because you can save, you can invest, and it'll be hard, but at the same time, it really comes down to, well, how's your life being lived? And do you have the ability to save?
And now I got to bring the tia, and Panchito and Francisco and everybody bringing on their money so maybe we could have the down payment, right?
Well, that's in order to contend. You made the argument, or you were stating a case earlier at the top of the show, talking about how you were outbid by this other deal, end up being FHA with money down and this and that. It's like, okay, well, how am I going to scrap together all this money that I need in order to buy a house, even if it is with FHA, but it's at $1 million or $1,050,000? That's a lot. Number one. And most people aren't making enough right now to be able to pay for their living and also save for the home. Yeah. They're like, I can do one or the other. I can't do both.
Exactly.
And that's evidenced by the number of people still living at home in order to save money, or living at home with parents or whatever, so that they can save enough money to then do the thing. It's like less and less people can do both.
Exactly.
And I also feel that it's like, I don't think I can, so I'm not. But if you're sick and you're like, hey, I'm not gonna healthy. Like I'm okay. So then you'll never know how to get healthy. But if you sit down and you actually create a plan based off whatever your situation is, then you could take little baby steps. Shit, crawl. Even if you're putting a little bit down, like whatever it is. But if you're going based off just your own calculations and what you feel and think about your life, then it's really difficult to know when.
But
and how
then
long
here
it's
it
gonna
comes,
take.
right? We got last couple of weeks we've been seeing inflation going up, so we started to see other stuff coming up in price too. And then now you have the interest rate where we were seeing like the low sixes, for conventional, mid fives for government, and now we're seeing almost the sevens.
Right.
Again. So it's kind of like resistance there. First I'm getting there, and now it's like, this happens. Like
it gets close, and then
you do become pessimistic of the whole process.
Mm-hmm. Yeah.
So it's totally understandable.
I guess put simply, people's salaries and income aren't matching,
that's
the rising cost of whatever, everything.
Do you remember the movie What About Bob? With Bill Murray a long time ago. It's old. The movie is older than he is old. I wasn't even born yet. But baby steps on the elevator.
Was it
baby
black and
steps
white?
in the hallway.
Yeah.
Baby steps in the office. Baby steps, and the whole thing goes about baby steps. And so you saying baby steps, Brian, unintentionally referencing What About Bob? Credit Bill Murray. Hilarious movie. Thank you for that. More people were denied on mortgage applications for insufficient income in 2023. And that's wrap. See you next week.
Yeah.
That's here's the nuts part to me about that, guys. This is when rates were still, like, let's say, attainable or within arm's reach, and at the same window of time that they're referencing here, when prices were kind of, 2021 to 2022, they were going up. But remember, like, summer of 22, they kind of, like, curbed off a little bit because rate hikes had already started. So kind of like our little, like, our peak and trough from any correction was around that 2022 time, and 2023 was just a trudge for everybody. So really kind of weird to me that there was more people denied during that time, but I get it, because you probably also had volumes of people from a numerical perspective. Let's say you had 10 million more people apply. Well, of course, then you have more people getting denied. So there's that element.
Math.
Too. Yeah. Math and super simple 101 logic. So
thank you, Andy.
Uncertainty is a problem.
Math expert.
For those of you who are watching this segment of the show and you're like, hey, I still am an aspiring home buyer, and I am not one of these people that's saying, oh, I'm never going to buy a house, or I can't do this and that. Like, look, here's the advice from the experts in the article: is be ready to financially absorb the other things that come along with home ownership. That could be buying new furniture, fixing the floor, painting the house, redoing the landscape. It could be the repairs and maintenance that need to be done. It's going to be upgrades and renovations that are required. Like, all that stuff matters, and you should be, let's say you should exercise financial maturity in preparing for those things, saving for those things, and also doing those things when they're required.
Yeah, and there's budgets out there that you can utilize totally for this stuff.
Yeah, budgets, Dr. Budgets. My good friend, Dr. Budgets.
And at the end of the day, it's an investment for your family, and it's also financial investment. I like that they say, you're going to have to eat other costs, but that comes with everything, So at the end of the day, if you're able to make this happen down the line, and they say, on average, homeowners are, have a higher net worth than renters. It is true, but it's gradually over time of them, making those payments, and that's the reward that you get, when you're renting. Unfortunately, you just don't get that reward. But I don't think, everybody looks at it like as a financial play for themselves when they're buying a house. Some are like, dude, I just need a roof over my head and a place for my kids and my dog to run around. But you come to find out that, those people then find out like, oh, shoot, I just sold my house 5 years down the line and I made this much. Why didn't I do this earlier? Yeah. And the point is, get in down the line. You yourself are going to find out your aha moment when you sell, when you refinance, or you do any transaction. But the first one is going to feel a little bit awkward.
Of course. Always does.
I'm so glad you always say that too. Like, just get in. Like, if you can get in, just get in.
Yeah, just get in.
Yeah, because again, you look at the long-term value of real estate. You look at the long-term return on real estate, because things are going to happen in your life, good, bad, and ugly at some point. And so it's like, well, you can either be a renter during the times, or you can be a homeowner at those times. Yeah. Renting's going to cost you something. Homeownership is going to cost you something. There's no way of getting it out without it costing you something. So, pick your pill, if you will.
Yeah. Now, you know what? It becomes an addiction too, because you start seeing how in the beginning it's very difficult, and you kind of get used to anything, right? Mm-hmm. Anything you do, when you got your first position for your job, or you started doing loans, it was like, how do I do this? But then once you understood it, it becomes addicting. Like, how do I help more people? Yeah. For me now is, how do I acquire more properties? How do I get creative in purchasing more properties, And then it becomes, how do I leverage other people's money to get into those properties? It becomes an addiction, because you see the wealth that it can leave, and the legacies that you can also leave behind. And being that it's simple economic supply and demand, we already know our population continues to grow. Every 50 years, proven fact that we double in population, and so here we are. And again, I say San Diego. I love San Diego. I don't know. I know we have certain tenant laws, rules, regulations, stuff like that, but I still love San Diego.
Hey, if you can invest in San Diego, your future's looking bright.
Yeah, exactly. I could drive to my investment property and see how everything's doing, say hello to the tenant, and hey, how's it going?
I do have a friend who will not buy an investment property that is more than a half a day's drive away. Yeah. And that's his radius, is if I can't get there in half a day by car, then I won't go.
Yeah.
All right, guys. So the next article is from CNBC. If your parents are homeowners, you are more likely to be a homeowner, housing expert says, and here's why. Homeowner parents are more likely to help young adult children with down payments, help them save money, and even show them how to achieve homeownership, experts say. Yeah. I mean, this is kind of par for the course. We've seen this, time and time again. We see this commonly. We see a lot of gifts. We see a lot of people gifting equity, cash, or, equity that's turned into cash to buy a house. Or in the case of a couple of your clients recently, just buying a place for their
they purchased,
kids.
We were in escrow for $875,000. And Dad he's very successful in Mexico, Tijuana here. our neighboring city. And so decided, let me just buy it. I need a tax write-off anyways. So I go, can you just put your daughter right there to get the best rate? She goes, no, I want to do this for my daughter because I need the tax write-offs. So I'm like, okay, let's do this.
Yeah.
We went in there, 875 property value came in at 830. And it was okay. I'm okay.
Yeah, he's like, I'm fine.
It's long term, you know?
Well,
the house is beautiful for my daughter.
Because the goal was to get her a place.
Exactly.
And I remember you telling the story about kind of dovetails, weaves into the whole legacy component of, like, even our conversation with Sophia on Friends of Mortgage Heroes, like creating family legacy and then having that in your trust and estate and plan and all that. And, like, that's what he's doing.
Exactly. Listen, guys, when you have that experience, I think it's easier for a parent to want their kids to have that same experience. And then since we see, okay, well, when we rent and we're paying all these rents, right? We don't see nothing in return. We have no tax benefits. We build no equity. Yes, we may have lower costs and stuff like that, but at the same time, there's nothing being saved for the future for us, right? Yeah. So as a parent, when we see that, okay, well, hey, I'm in a 30-year. I've been 15 years in the home. I owe 15 years left, and my value's here. I can help with some of that equity to go help, you know, my son, daughter, get into and go through the same cycle that I went through.
No, and I feel like renting is more of that like instant gratification. It's done. Cool, I'm done, and I have to worry about it. No headaches. But then when you buy, you're getting that delayed gratification. Damn, the pipe went off. Oh my God, that's not working. But then you sell and you're like, it was worth it.
Yeah, because
it was worth
okay,
it.
So,
it was worth it.
And it's so true, right, Brian? Like, let's take a look at this. So you're paying rent, and you're paying rent for 3 years, right? You get out of that place. What do you see from that money? Like,
hey,
what do you get?
Thank you for being a really good tenant and giving me your money on for the last 3 years.
So I'm going to go and I'm going to purchase a home 3 years later. I want to sell. I almost recuperate what I invested into that property. I may not recuperate all of it, let's just say, but I recuperate most of it
10,
and I
20,
get taxes.
30, 40, 50,
I get the
60,
benefit of my property taxes. I get the benefit of, hey, it was mine. So there's different things. So I that's why for me, I would encourage my kids and I'd go through this. Like, you got to be a homeowner.
Well, you have.
So I understand this.
In this example, it says in 2023, about 23% of first-time buyers used a gift or a loan from friends or family for the down payment of their house, according to the National Association of Realtors. Even if they're fudging that number to the upside, let's say it's still 20% or 15%. That's a considerable amount. It's statistically important.
Yeah.
And then Zillow, their chief economist Scott Olson said that 40% of first-time home buyers source money, quote, from the bank of mom and dad. Mm-hmm. So not to dismiss the fact that people can save their own money and also, do their own, let's say, benefit their own financial well-being, but that the bank of mom and dad is stepping in to some degree to help out.
And the approval, the requirements are also very, very low. You just have to be their kid. They have to love you. They have to, want to see you do good. And hey, just do your best. And
that's it. We're not going to do a DNA test.
There might be some sort of interest, but don't worry. You can carry that back and, pay them never.
And make sure you don't get excommunicated from your own family.
Here's another misconception, guys. We always think that the gift's got to be from a family member, right?
Oh, no.
An uncle, an aunt, or something. But we got a transaction where their company actually gave them the down payment.
Oh,
because they had a situation where we have enough funds that we pull together, and on an annual basis, we can give it to somebody who is an aspiring homeowner or whatever it is. In this case, the company was able to give them the down payment. So there's other ways.
Yeah, and I think the idea of the down payment, and in this position, they're saying yes, if your parents are homeowners, that's true. But again, down payments can come from a lot of other sources.
Correct.
The parental part of this, I think, I think the main point of it was that intergenerational wealth is created through real estate.
Correct.
And I'm not saying only real estate, but there's an association with home ownership and passing across and down intergenerational wealth, not just 401k plans, IRAs, cash savings, life insurance policies, that kind of thing. It's that home ownership and real estate is part of that mix and a good, healthy portion of that mix.
Yeah, I remember growing up in La Jolla, we used to be like, it's because you're a trust fund baby. Right?
In La Jolla. What?
We used to talk to the kids from La Jolla and all that. It's because I have all the trust fund baby, right? I mean, but it is generational wealth passed on through.
I once heard somebody say they grew up poor in La Jolla, and I was just kind of like, Well, what is poor? Please break that down.
Elaborate that.
My parents only made $600,000.
Yeah.
Oh.
Did you eat at the dollar menu?
Oh,
Jack in the Box.
Yeah. Well, I think that this also goes on to prove something we talked about earlier, which is adult children staying with parents in order to save down payment, plus parents gifting funds or equity into cash or whatever, is the combination of efforts in order to achieve homeownership.
Or the efforts of just getting them out of the house, Andy.
That's true.
How do I become an empty nester here?
But again,
Bye.
let's
build wealth.
Let's think about this
Hello.
Let's think about this from a purely legacy perspective. If you have the means and you are aware of what's going on, and you know what is, let's say, you believe what's best for your own children is for them to have their own place. I'm going to do that. I'm going to do that too. Yeah. I'm going to be like, how can I make this work for each of them?
One of the things that I was reading in the articles, and I don't know if it was this one or prior ones, but they said basically the younger generation that's opting to stay at home with their parents are able to spend more luxurious, meaning that they have that extra money, right? I was thinking, and I don't know here, I'm just kind of throwing it out on the table, right? So consumer spending is still very high. I don't know what number or what population of these people that are living at home have very high paying salary jobs that are very comfortable at home that don't have to pay a big, living expense a month. How much of those is attributed to them still being able to spend freely without them being able to pay that, big monthly residual rent pay or mortgage because of the fact that they don't need to? Now, I'm just curious to see how much of that is actually fueling, our consumer spending.
Yeah.
Well, I think it goes hand in hand with something we talked about earlier. Is like the money's just chasing things. Like every month, your money's being like competed for.
Yeah.
It's the gas in your car. It's the food at lunch. It's the food at the shelf at the grocery store. It's the electric bill. It's your cell phone. Like nothing in my life has gone down in the last 2 years for cost. It's only gone up. And I'm not saying just volume of what I'm buying, just the cost to buy the same things. It's gone up or the size has gone down. And so there's a huge component of this where that's going to work for some people and not for others. I mean, that's just the bottom line. It's going to work for some people and it won't for others, irregardless of whether or not they're irregardless. That's not irregardless.
Don't ask. Why you look at us if that word is right?
Regardless.
Oh my God, that sounded good.
Sorry. Regardless of what the parental involvement or not involvement is when it comes to homeownership, it's just it's the dollar just being chased after every single month by everything in your life. Competition for your dollar. That's it.
And then at the end it says renter parents may express more sour grapes about the idea of owning a home. If you didn't do it, they're not going to talk it up. And I'll bring up an example of, I was a psychiatrist or a psychologist that did an example on two sons that had an alcoholic father. Yeah. One of them had a horrible experience, said, I'm never drinking. I'm never going to be like my dad. I'm not going to do that. I'm going to do this, and that, and show my family that I'm this because of the experience that he had. The other kid was like, yo, I'm a drunk. This happened to me. Life's doing this because of my dad, the way that he was. That's why I am the way that I am.
Right.
Now, the tale of the two brothers is that they're both came from the same situation, but it prompted them to take two different outcomes. Yeah. And I feel that, that's still a big play in today. Yeah. If some people really want to buy a house, like, dude, my situation was horrible. I didn't have a house growing up. Like, I need a house and I want to have a house. Yeah. Others are like, yo, like, I don't know. I guess it's not for us.
Yeah. It's personal agency.
And I think the article did a really good job at, tying it to your parents because, that's your first line of defense in learning anything, you know? So if they didn't give you a good basis, anything after that, you're basing it off your primary years of learning.
Yeah, there you go. Yeah. So I'm a good role model.
Yeah.
I love debt.
There you go.
I love debt.
We're dad.
No, you love
so in debt is
other
crazy.
people's debt.
Yeah.
Well, debt on me, but at the hands of someone else's, so.
Yeah. Although, you know what? The only one here is, I already told Dylan, you can live with me forever. He's so under the radar, so chill. Ashton, how do we give you the down payment? When you're done, graduated, how do we give you down payment?
It's already in your account. You're good. Just
it's earning interest. Make sure you...
See you later.
And if you need nothing, don't need anything.
No, I'm kidding.
So what do you guys, what would you say was your favorite part of the show today?
Actually, my favorite part of it is that dads and moms become a piggy bank, pretty much.
The bank of mom and dad.
The bank of mom and dad.
I like that because we're always trying to set the example of being good role models, And so when you're reading this, people are paying attention. There is stats against all of this. And so I want to be part of that stat in that I'm able to contribute to, my 5 sons, get them into their home, help them out. And I think that longevity, it's a good thing for them, especially for them to show their kids. And I just want the tradition to go on.
Good for you. How about you, Brian?
I think for me, it's going to be the people that didn't think that could buy houses because, it's never going to happen. I think there's hope for them. They just really need to, come up with the solution and not just, take their own ideas and take their own advice. You could do it if you, like I said, if you take the time and actually plan it out, baby steps.
Yeah.
Because down the line, you're going to want to do it. Might be too late. Yeah. Everybody wants to buy a house, but, sometimes your situation isn't there. So fix the situation.
Totally off the subject, I want to add to that. When people are going and they're running their credit, totally irrelevant from this, is I suggest people put themselves on the do not call registry before they run their credit. I'll tell you what that actually means right there is when we pull application, we get them approved, like these people that don't know, we're always trying to encourage them, like, just bring us, we'll create an action plan behind it, right? But we're going to run your credit. So when we run that credit, you're going to have all this solicitation. So when you register yourself on that we should put it on
We'll put it on the show here. Yeah.
The WW do not registry.
No. Do not call registry.
Do not, yeah,
read the description.
It's on the screen.
It's on the description.
It's on the screen.
It's on the screen. Do not call registry.gov. We'll put that in there.
They're going to look at it because of that.
All they require is phone number, add yours, your spouse, or whoever you want there, your email, and then give it around 72 hours before anyone runs your credit, because otherwise you will get bombarded.
Yeah, that's a great piece of advice. Do yourself a favor. Save yourself from a massive headache of fielding I shouldn't say fielding calls. Ignoring a ton of calls. Just do the donotcall.org and you'll be fine.
Yeah, and that's for anything, for mortgages, solar, for anything.
Yeah, getting a car loan, credit card, the timeshare you shouldn't be signing up for.
You could also opt out yourself out of, mail. There's so much mail fraud here in California. So much. Yeah. You go to Experian and you can go in there and remove yourself in it for 5 years. Yeah. So.
Well, you guys will probably not be surprised that the favorite part of the show for me today was, well, what do you think it was?
The do not call?
No. What do you think? Go ahead. Guess.
The down payments.
All the percentages and numbers and math.
Yeah.
Thank you guys for watching. We'll see.
Yeah.
The favorite part for me was the median down payment. Like that map is fascinating.
Cool.
I really like seeing the visualization of it. And my brain starts looking at all the figures. Like, oh, this means that, and that means this. So I was kind of nerding out on that. I was really excited for that part of the show today, and I think that was probably my highest energy moment of the show too.
That's awesome. You know what? Florida, that did amaze me right there. I didn't share that, but Florida was also one of the highest, the 98,000.
Yes,
that was pretty crazy. I go over there, I'm like, how? Where?
But that goes back. That's the same argument. I thought for Texas, I thought Texas would see the same thing because of the rush of people going there and how much money was chasing them.
But I see a lot of people from New York actually retired down there.
Yeah. Yep.
Especially in Key West.
And more to come.
That would be my place. They got good key lime pies. What they're known for.
Thank you guys for another great show.
Most southernest place.
All right, let's finish it before. I don't know if
it's
serious.
We lost everybody at Key Lime Pie. Well, thank you guys for another great show. Good job this week. Thank you all for watching the Mortgage Heroes podcast. Remember to like this video, subscribe to the channel, share this with someone you know, love, and care about. And remember, if you have not checked out our other playlist called Friends of Mortgage Heroes, Brian, Will, and myself interview our friends in and around real estate, talking about their career, what interests them, and how we can best bring more value to you. So thank you for checking all that out. Thank you guys for a great show, and we'll see you all again next week.
Later, guys.
See ya.